Oil companies like mine are paying for Trump's trade war with China. It's about to get worse. While the full effects of the trade war between the United States and China have yet to hit the pocketbooks of most Americans, many parts of the US economy are feeling the pinch. Even with the preliminary trade deal reached last week, the oil and gas industry has been especially vulnerable. While Americans are working in US-based oil and gas fields to produce the energy that powers our homes, cars, and factories, much of the equipment they use, the valves, compressors, wellheads, and other parts, comes from China, where it has always been cheaper. The exulting tariffs have increased the cost of importing equipment from China that oil service companies like mine depend on by as much as 25%, a significant amount in a low-margin business. This has disrupted the global supply chain and forced US companies to find more affordable suppliers, mostly in Vietnam and other Southeast Asia countries. While there has been no impact to that on US oil production, and thus no effect on prices, and the palm liquid natural gas export projects that have yet to secure long-term contracts are at risk because of the added cost of tariffs on the China side. If US producers can find export markets for their gas, they won't invest in new drilling, which will eventually lead to a reduction in US production. The US price of oil is currently trading at around $54 a barrel, a precious level for shale producers who barely break even at the price. Crude oil traded as high as $76 last October before the trade war took off and energy commodities became a target. Economists now fear a global recession. At best, they see an indefinite trade war that eats increasingly into global economic growth and thus on demand in a big way. Both OPEC and the International Energy Agency, the Paris-based watchdog for the world's major economies, have shelved their 2019 and 2020 oil demand growth projection in recent months. I would not be surprised to see oil demand growth projection drop below 800 barrels a day. As global oil demand growth seems, American oil producers find themselves locked out of the world's largest market for oil imports. That's because China imposes a 5% retaliatory tariff on US crude oil on 1 September. So far, this has not been a big deal for American producers thanks to the availability of other markets in Europe, South Korea, India, and Japan. But the shale sector is about to unleash a massive huge of all thanks to the start-up of roughly 1.5 million barrels per day of new pipeline capacity from Texas fields to Gulf Coast export terminals, and Europe, South Korea, and other big importers don't have much more appetite for the light, sweet shale oil Americans produce have an offer. But China does, without access to that market. US exporters may struggle to sell these barrels and be forced to offer sharp discounts to get global importers to take them off their hands. With industry profit margin already on knife's edge, lower export price could push them deep into the red. That in turn could prompt producers to rein in capital investment, which would cut production growth targets next year. Energy market watchers, including the Energy Information Administration, already predict a slowdown in shale output growth in 2020 due to the sector maturing. While current surging output from shale means America is now producing more energy than it needs to meet domestic demand, It also means that every new incremental barrel has to find a market board. That challenge becomes increasingly difficult with China, that world's large oil import market, is suddenly off limits. On the other side, even a partial deal truce between the Trump administration and Chinese leader Xi Jinping's team would likely unleash up to 500 barrels a day for US crude export to China. This reached the level China was importing from the United States around the time when their trade war began. But there's room for China to buy even more American oil. That's because there's a strategic upside for China here too. Beijing has offset the loss of US import mainly by buying more Saudi oil. It's a good bet that ever after that September 4th attacks on Saudi oil facilities, which temporarily knocked offline roughly half of the OPEC members' output, that Beijing would like to diversify its suppliers. The threat of war in the Middle East, along with US sanctions on Iran and Venezuela, must have China examining its options. The US shale sector remains on solid ground, but it could use some help from the White House if it is to deliver fully on the promise of energy dominance. The resources are there for American oil exports to increase by nearly 5 million barrels a day over the next 3 years, but whether or not this happens depends on China once again becoming a willing trade partner.